Thank you. And with this, I would like to invite the panelists of the first panel and the moderator of the first panel, Rebecca Christie, to take the seat. Please, the floor is yours.
Hello. Thank you all, everyone, for coming. Thank you for being here. Where's my panel?
We move over, right? Yes, please. Yeah. Sorry.
We have, while they come up, a wonderful panel. We have the Minister of Finance, Investment and Economic Development of the Republic of Poland, Minister JERZY KWIECISKI.
Bravo.
We have JOHAN van Overtveld from Belgium, from the same country I come from these days. Now in the Parliament and former finance minister also.
Yes.
We have Gabor Gyon, State Secretary from the Hungarian Finance Ministry, and Daniel Kreczynski, Chairman of the Board from EPH in Prague. We are here to talk to you about preparing for the next recession, which raises the question of when, how, and why. It's probably worth, as we have that conversation, thinking about the relationship between the euro area and the non-euro countries, the relationship we have between the countries and regions that are converging and growing closer together, and the countries and regions where, regardless of where they are right now, they're diverging, they're moving in different directions. And this direction of economic travel is going to be as important going forward as the overall standards of living, because, for example, if Eastern Europe is growing faster than Germany, then you have people moving closer together. But if you have the south of Italy, for example, a region that is not growing faster, it's not able to keep up with any of the other trends across Europe. So those are some of the things on my mind. Certainly for the euro area, it's a time of great transition, a time of great internal disagreement. And Minister van Overtveld, you will be able to tell us, perhaps you're our euro area person here, how you see this great dispute, this unprecedented public dissent within the European Central Bank right now, how this affects our outlook in terms of people's confidence in the economy. We also have negative rates. We have a whole lot of things going on. So that's the backdrop I would like to be in your minds as we move through and we hear from each of our panelists. I think we will have a few opening remarks from each one, maybe a little bit of back and forth, and we've only got an hour, but maybe there'll be time. Are we doing Q&A at these things? Is there my audience mic? Excellent. So with that in mind, we'll just start here and move this way, or do you have an opinion? Daniel, you want to go first?
Absolutely.
Give it a shot.
Thank you very much. Very, very few remarks. First of all, from the industry perspective, I think we don't have too many reasons to be extremely nervous under certain conditions. Of course, we see the trend of the industry slowing down. We see quite major problem in many regions with the workforce, not only with the cost of the workforce, but also with the availability of the workforce, which starts to be an issue for the industry, but at the same time it signals healthy development of the unemployment rate, which is effectively a key condition of a social cohesion and good and sound and sustainable situation for the future. My main concern today, frankly, comes from the political side and from the fact that certain ideological approach, which is gaining more and more weight in certain, especially Western European countries, and also inside of the European Union institutions, may create some damages. I wouldn't say that this has really happened so far, but the signals of hearing these voices is stronger and stronger. A few examples. When we are talking about competitiveness, I more and more hear our visions and thoughts about industries where we are not strong. We want to create a super fund that would invest in the digitalization and that would try to create conditions so that a new European Google can arise. From my perspective, this is a lost battle. We will never succeed. Any money that can invest will not create a balance with the big tech US superpowers. But we have other industries which are key in Europe and which are extremely strong. It's automotive industry, generally manufacturing industry. Also chemical industry is important. And in our talks, especially at the European level, I don't hear anything which would show a real and true interest for these industries. And when we are talking about competitiveness, we are talking about the competitiveness of something which we would love to have, but we are not talking about the competitive conditions for what we have and what makes us living every day. The same, unfortunately, in the very important domain of the climate change, where also already today we hear a narrative which is unconditional and which for me is very dangerous. If we see here, or if we hear today that we want to end up or land in a carbon-free or carbon-neutral situation, this is something which is for me scary. Not because I would be afraid of the practical policies, but I'm afraid of the signals that we are now sending to the industry. How if I was in the board of directors of a chemical factory, for instance, or even any manufacturer that is using welding, how I can decide about investment in a new factory in a situation where I don't know what kind of technologies I will be able to use and what are the costs of these technologies. And I have to say that the technologies are not available and the costs are unknown. So I think it's also extremely important that the narrative that we are using when talking about our goals is always sending clear signals that industry is welcome in Europe and that we will care about the terms of the industry. If this political layer is there and is supporting the competitiveness, the substantial competitiveness of European industries, I would tend to be very optimistic because European people are able to work in a very organized way. The huge disadvantage in terms of level of wages that we have experienced in the past vis-à-vis China, for instance, are a little bit narrowed down. So I think fundamentally we are not in a situation that is too frustrating, but we can make it make it dangerous if we proceed in a too ideological way. Sorry for being so long.
Thanks very much.
Well, the title of the conference is preparing, or of this hour, preparing for the next recession. You can only prepare yourself for something of which you know the diagnosis. Why it is that we have indeed today a downturn. There clearly is a downturn in the European economy. Whether it will be a recession remains to be seen. But if you then start looking at the reasons why we have that downturn, I think there are basically two things. First of all, we have had a quite long expansion, not a very pronounced expansion, but quite long. So it's normal that at a certain point you get kind of forces going in the other directions. That's the I would say the normal business cycle. Second element, and that is of course multi-layered, is the big word uncertainty. You have Brexit, you have the trade wars that have been mentioned by Mr. Ambassador, you have the situation in the Middle East. Maybe you heard also about the fact that today there was another attack at an oil tanker in the Middle East, and a lot of things building up in terms of uncertainty. Also, under the label of uncertainty, the climate issue, which is of course very important, but we're all shouting and screaming, but I think investors don't know what will come. What kind of actions will the political world take? What kind of measures, what kind of framework will be built in order to do something about climate change? So I can understand a lot of companies who are holding back on investment because where is this whole ship going? And then I come to what you suggested in your introduction. I think there's also a lot of uncertainty due to the central bank policies. Because I am very fond of Greece and I have a lot of Greek friends, but if I see that Greece can lend at negative interest rates, then I say something is very weird in the financial world, and that's an how should I say, an underpronouncement of what my real feeling about this is. In Belgium, we have, just to give you an example, we have 300 billion euros in saving accounts of mostly elderly people. A simple calculation shows you that in the last 7-8 years, these people lost more than 15% of the purchasing power of that money. 15%, that's 45 billion euros a year. That's 10% of our GDP. the impact of what the ECB and until recently also the Fed and the Bank of Japan have been doing is massive. And I think we should all build a statue for Mr. Draghi for what he did in 2011, 2012. He saved the euro. But what has been happening since, there I am a lot more critical. And let's be humble. They had to navigate a ship in waters nobody has ever been in. After the 1930s, we had a depression, we had a world war, and the situation was totally different. We came out of a financial crisis that was as worse as the crisis of the 30s, and luckily we didn't have a war. So other things needed to be done in order to keep everything going. And they've been doing that, but according to my humble opinion, they've remained much too long with these policies. The Federal Reserve has been stepping back on them already 2 years ago. So they have some munition in their depot, if I may put it that way. But the ECB has not left much ammunition. And now we have that internal fight. I wouldn't like to be in the shoes of Madame Lagarde, who is inheriting an ECB that is thoroughly divided on what needs to be done next. So there's a lot on the plate for Europe. I think getting things straight on the level of the ECB, and I'm a big supporter of the independence of the European Central Bank, but that cannot prohibit us to pronounce certain criticism of the policies. So they should get their act together, and they should reverse policy. They should reverse policy and stop with negative interest rates. It's amongst others also killing banks, insurance companies, and pension funds. It's quite obvious. Just look at their balance sheet and you see what's happening. And it's also, and that would be my last remark, it is also a very bad thing for what has been labeled by the Bank for International Settlements and others, the financial cycle. We go from one bubble to another. We have today a huge bond bubble. I mean, unless you're blind, you see that we have a bond bubble. But we have other bubbles too. You all remember the collateralized debt obligation market, the CDOs, 10, 12 years ago. Ladies and gentlemen, we have today exactly the same thing with the CLOs, the collateralized loan market. Mm-hmm. It's a market that has doubled to $3.5 trillion, and it's the same principle. Credit is given to companies, to corporates. That credit is, for example, given by banks who take it off their balance sheet, securitize it, translate it into tradable paper. They get a rating agency stamp on it, usually rather high, and then the thing disappears in the woods.
Do you see those being issued in Europe?
It's all over the place. $3.5 trillion is a huge amount.
But that's worldwide versus the European markets.
That's worldwide. And so one gets the impression that the risks are gone because it's in the market. No. We learned that with the subprimes and other mortgage loans. It's not gone. It's not because you don't see it that it isn't there. And so that financial cycle, whatever some people say, is fueled, amongst other things, by very low, let alone negative interest rates. And that's also something we should stop. So let's diagnose where we are, and let's, in function of that diagnosis, adjust policies. It won't be easy, but there's no other way to do it.
Thank you so much. That raises so many additional questions from everything you mentioned. Tomorrow morning, we're going to have a panel on capital markets union. So in particular, if you're interested in looking at these issues of what's happened to savings accounts, why are they sitting in the bank losing money instead of going into other investments where there might be more return. Why is it that you can buy an exchange-traded fund for a reasonable cost in Italy, but in Belgium you'll end up with paying 4 or 5% by the time you finish signing all the papers at your banks? How do these decisions affect what happens in people's savings? So we're going to talk about all that for about an hour tomorrow. Hope to see you then. In the meantime, as we move out of the Eurozone, I'd also like to stick with this issue of shocks from outside, because the risks that are in these financial markets, like collateralized loan obligations and other risks, those are very much global risks versus things that are coming entirely from the euro area. So those are things, or from Europe, those are things that need to be kept an eye on, watched, but they're not something that Europe can necessarily affect from a policy perspective. So where do you see things going now?
You know, our panel session is about recession. I can tell you that in Poland, we do not know this term. I mean, since 27 years, we haven't witnessed that. Together with Australia, this is the two countries who managed to avoid that. So for younger generation, you ask them recession, they do not know what you are talking about. And also, I think in principle, you know, in Europe, we have quite a high level of life, say on average. So if you ask at the street an average person and ask him about recession, he's saying what? You know, as long as he's got his job, as he's paid, as he can afford going, you know, with family, for holidays, and this is, as long as he can go almost, maybe not every day, but every second or at least over the weekend, to a restaurant, these people are not really very much interested, in all this strange economy. So, but of course, I'm very sympathetic what Johan said. I mean, the threats are not over, and I would say there are even more of them. And for me, the big question is whether this will be recession or whether this will be a slowdown. And I think this will vary from country to country. And that is also, interesting that, say, Europe is growing very anomalously now, So in our region, the growth on average is now 3 times bigger than in Eurozone. Normally it was twice, twice as fast as in Eurozone. Now it's 3 times. We have also some signs, of this, for the moment, slowdown in some countries of recession. We shall see soon whether in Germany this is a slowdown or recession. In Italy, this is clearly recession. But I would say there is no such a clear cause of that slowdown or recession as it was 10 years ago. So clearly the slowdown in our part, this is because of the trade war and the effect on the on the industrial sector, especially on the automotive sector. We can see that in the case of Slovakia, that is spectacular because the growth has been decreased by 2 in a very short period of time. In Germany, it was even much more substantial. But as Johan said, we have other bubbles, And when we have a real recession, what the EIB will do, because they already have, negative rates. Fiscal easing is not very popular in Europe in general, but this is what we are doing in Poland already now. Still, when we are growing 4.5%, year to year, to do it now. No, not at the moment when you are in the recession, because it will be then too late, and then you will have, the effects of this fiscal easing in 1, 2 year time. So you have to start doing, that now. And also, I'm very sympathetic. So what Mr. Kretinsky said, that Europe is not fascinated now by issues, by economic issues, by recession, but we have, say, many other interesting. In Poland now, we are in a campaign. In fact, today is the last day of campaign, and we have parliamentary elections tomorrow. Do you think that we discuss about economy? Not at all. I mean, this is not of interest of the, of the societies. The major subject which you might have seen, over the last months in the number of countries, where climate, LGBT, other such funny issues and not economy. And I'm saying, you know, as long as people have good standard of living, as long as they keep jobs, as long as they can afford, you know, to pay for, you know, for these major elements, they will not complain. They will not get interested about that. So, you know, what I can see are the major challenges, you know, in relation to that. For me, is really to strengthen the economic strength of the European Union. And I always compare that with the United States, but soon we will be comparing not only Europe to the United States, but also to China. You know, United States is now 350 million people. Europe is 500. The economy is bigger but about 1/3. But 10 years ago, slightly, but our economy was bigger than of the United States. That means, they grew faster. It's also, interesting because when you compare openness of the economy, the economy by the ratio of exports to GDP is twice less open than our economy. What that means? That they have, to a large extent, they exploit the growth potential of the internal market, not of our. And what we do, it's the opposite. We have this famous 4 freedoms. Maybe soon we will have the 5th one related to digital market. But the most important now for us is the services market. Is it freedom in the services market? Not at all. Even I can see the opposite. What you can see now, in the transport sector. So we in Europe, we are not exploiting the potential of our internal market as they do in the United States. Another important issue which you will talk about tomorrow is related to innovation, because if we want to be stronger, and also if we want to be richer, and this is especially in our part of Europe, we must be much more innovative. That's true. And banks will not finance innovation. You can ask bankers, And if someone worked with startups or even with innovation large companies, you must cheat them if you want to get some money, for them. That's of course possible. I mean, you could confirm that, but I would say that's not easy, and that will not work for the whole, economy. And if you look at this capital, you will see in Europe we have 5, 6, 7 times less, this risky capital. So that means capital who could finance innovation than they've got in the United States. Even more. We have now 3 times less of this capital than in China, and they did it in 5-year times. So capital markets are crucial for that. And if we don't do that, we will not, succeed. And the third element, which is also, related, to that, is R&D sector and commercialization of the results of R&D. We are the best performers in that area in the world. Our spending on R&D is the biggest in the world. But what happens with result of that? Do you know that half of the startups, and these are the data of the European Commission, half of the startups from Europe, they escape from Europe? And the capture capacity of such a small country like Israel is at the same level as of France. And France probably has the best scientists, in Europe, especially in biotechnology, in physics. So, what that means, that everything what we, not everything, but quite a large part of we invent, this clever people which we've got, and also, good companies, they all escape from Europe. you know.
It's a great way of bringing the threads together, because we have this situation where people are losing money by keeping it in their bank accounts, but they're keeping it there rather than putting it out at risk into the economy.
Because they have no debtors.
And because cross-border lending and cross-border financial services are not where one might like them to be. And generally, innovative companies have this problem of scale and have this problem of growing and financing.
I didn't want to go into detail because you will have this panel tomorrow. But you know, I think that without solving the you know, this problem, we will not manage. So as I'm saying, you know, we will still keep our level of life at a decent really level, you know, in the European Union. But, you know, the others are growing much, much faster. So I'm saying we will be much more vulnerable to, you know, to any shocks, you know, to any bubbles in the future. So, I mean, in principle, I must admit, I'm positive, you know. I can't see any big recession risk in my country, in Poland. Also, as you know, as a finance minister, I was told already 2 years ago that, you know, next quarter I will have a slowdown, substantial slowdown, so I have used to that. And our performance was even better than anybody predicted, but you know that goes for the whole, you know, for the whole region. But I very much agree that we have to look at the whole Europe, and that we have to consider what's happening globally, not only, you know, in Europe and not only in our countries.
Thanks for bringing all that together, Minister Guillaume.
Thank you very much. Well, it is very hard to say something new that hasn't been already said by these very intelligent people, but I can assure you, Mr. Minister, that Hungary knows what recession is, and we hate it, and still remember it, and it still hurts. Not recently, since 2013, our economy has been growing, and in the past 2-3 years in a quite spectacular manner. So, but we still remember recession. I mean, let me just share you a story. 2 weeks ago, I had a lunch with a friend of mine. He's a CFO of one of our large bank in Hungary, and he's usually a very skeptical person. And he asked me what I'm dealing with currently. I said, well, I'm working with our economist in the Ministry of Finance to kind of work out some economic stimulus packages just to tackle recession, downturn, eventually a crisis. And he told me, he said, don't worry, crisis will not come. I said, well, what do you mean? I said, well, crisis usually don't come when everybody's expecting it. Crisis usually comes when nobody expects it, or just very few people expect it. And he says, but what you can achieve is a recession might come if you keep talking about recession, because you actually make people and companies worried and spend less. And this actually we already see. Some projects, especially in Western Europe, being delayed for no specific reason other than fear of next downturn or recession. Nevertheless, I mean, we do see areas of concern, and these areas of concern being mentioned. I mean, Hungary is a small, open economy, so anything happens globally or in Europe doesn't escape us, and we need to be prepared for that. Trade war is clearly the biggest one when we start listing the potential issues that can cause downturn. Now, the thing with the trade war is the way I see it. I mean, trade war is created by very distinct decisions, and I believe when the results will start to hurt, and I because of the globalized economy, I think there can be no winner in a trade war. Can be only losers. And when it starts hurting everybody, those decisions can be reversed. So actually addressing the impact is relatively easy. Brexit is the next area of concern. We just hope it will be short term, that situation will stabilize, whatever will happen. Our third area of concern is German slowdown. I mean, we've been so much attached to German economy that if Germany sneezed, we got a cold. And but there's some good news as well, because our almost 100% correlation with German industry has actually completely changed in 2019. In the first 6 months, German industry contracted, decreased, and our industrial output increased by 6.3%. So that's kind of a good sign for us. We see some turbulence around the automotive industry. That there is a shift, there's uncertainty how the automotive industry will change. Now everybody's talking about this will be electric cars. I'm not sure that we'll end up with electric cars. We'll see where it will end up, but there will be certainly changes around the automotive industry, which is, again, that's 5-6% of our GDP that causes us. And my main concern is actually, is there something that we're missing? Because if I look back to past crises, first of all, those crises were not caused by direct political decisions. Those were caused by market forces. So is there something out in the market that we're missing? And if something, is there a bubble? I mean, Johan mentioned one.
Yeah.
It's a bubble, which causes a very... The problem I have with that bubble, that would actually replicate the previous crisis. Now, crises are usually not identical. So they usually come in some different form. If you look back, the subprime crisis, the elephant was in the room, we just ignored it. With the dot-com bubble, again, the elephant was in the room. Are we having several bubbles now? Would this be cryptocurrencies? Will this be, especially if Libra takes on? Because that will have a massive reach. I mean current cryptocurrencies have fairly limited reach. Is that a technology?
Let me answer that.
Technology advancement, technological revolution, and we are praising the technology and innovation, and we need, but quite often we are actually failing to assess the social impact. And when we are talking about robotization, automation, are we really thinking about what social impact it will have on jobs that will no longer exist? What we will do with those people? I mean, many. If you listen to these technology think tanks and visionaries, and they talk big about technology, and they say, look, we are at the start of a next industrial revolution. Well, if that's true, we should probably go back and look what happened with the first industrial revolution. I mean, long term, it clearly raised the level of standard of living, but in short term, it really caused significant issues. So I'm just guessing, but the most thing that concerns me is the one that we don't see, or we don't talk about it.
That is a
Now-
great way to frame the unknown.
Yeah. Now what we can do, I mean, of course, I think it's good that we are cautious, but we need to take actions. And I think one pain point of Europe, especially Western Europe, is low level of investments. I mean, that's, and this being discussed, and something has to be done. I mean, ECB can no longer decrease rates. I mean, it cannot abandon quantitative easing. It's already in place. I think, as Mr. Minister said, I think it's time for fiscal easing as well, and to raise level of investments. I mean, investment level, the way we look at Hungary, I mean, our midterm plan is 4% annual growth each year. In order to achieve that, we need an investment level of 25% of GDP at least. Then we can do it. And last year, ours was 25%, Sweden was 25%, Czech Republic was 25%.
We were 8.
And the other is flat, is very, very low. I mean, this year, our investment rate will probably end up at around 29%. So I think action needs to be taken. I mean, we see signs of concern. We see signs of slowdown, whether we are causing it by talking about it too much, or it is caused by these factors, but I think actions need to be taken. I mean, the recession will not go away by just talking about and stating the fact that there is a recession.
So as we move back to the other half, I'd like to tie a couple of things together that you may or may not have seen the connection between. One being quantitative easing and fiscal policy. We talked a lot about negative rates already. We didn't talk much about QE. And we didn't really talk about the German resistance to fiscal policy at the same time that the Germans are very unhappy about the current state of monetary policy. That would seem to be a tension that is not in a very happy equilibrium. And to connect that to the cryptocurrency and or crypto asset conversation. And Johan, when you answer that, I would love it if you could draw the distinction between what is a real currency and what is a digital asset, in addition to talking about, transaction costs and innovation and all the things that we talk about there. Because the beauty of Libra on paper was that it was going to have central bank support, and so it would have something standing behind it as opposed to being, Bitcoin tulips, for example. But if there's one thing we've seen, it's that central bankers don't issue currency together and are very wary about stepping outside of their traditional sovereign control over monetary transmission channels. So moving into cryptocurrencies and merging that with central banking at a time when central banking is at its limits and fiscal policy isn't stepping up, and there's one very large economy that maybe has control over many of these levers. I would love to hear your thoughts on that.
And what was your question?
Germany.
You said a lot, and I was surprised that you say that central banks want to stay in the confines of what they know. I think we all know the expression that the central bank needs to be a lender of last resort. The central banks we know today have become the dealers of last resort. They're dealing in the market. They are very skeptical about Libra. For me, in terms of public choice theory, is quite simple. It's a competitor. And Libra, if I don't know whether you read the book or the report that goes with Libra, that's serious business. That's very serious business. And if put on the market as intended by Facebook and MasterCard and the others that are behind it, it might become, in no time, a very real currency, out of control of the central banks. So they are against it because of that, not because they are afraid of whatever might be strange vis-à-vis their traditional line of business, because they are already way out of their traditional line of business. I want to come back, if you please, or if you allow, on that indeed history repeats itself, but never in the same way, and that what I suggested to be a problem in the CLO market might be just a replicate of what we saw in 2007, 2009, and to a certain extent you're right. But the big difference, as far as we can see today, is that whereas in 2007 the CDO paper was to a large extent on the balance sheets of the banks and their off-balance vehicles, this is not the case this time. The banks are not joining the party as they did in 2007. Then, of course, the question is, who is doing the cha-cha-cha? My guess, but one of the horrendous things about this is that we really don't have the good data on this. Those who are searching for yield in the financial market must be involved. Cannot be otherwise. Otherwise, you cannot have a $3.5 trillion market. I mean, you need to have some people who want to buy. So I'm thinking about insurance companies, pension funds, and that kind of stuff, who, in order to be able to meet their liability side of their balance sheet, of course need assets that bring in more than -1. It needs to be plus, otherwise their liability side explodes. And so if this development, and I'm not absolutely not saying that that market will explode, I'm only saying that it is, well, let me use an understatement. It is a strange market at this point in time. And as a matter of fact, the Japanese regulators have been taking measures to limit what is happening in that market. So it can come from that side, can come from any side. And certainly with respect to a third element, the fiscal element, I understand the German and the Dutch opposition to across the board facilitating more deficits. I understand that. I mean, they've got there. They have budgets in equilibrium. Their debt is going down. They have, of course, like all of us, demographic issues coming up, against which you are much better armed when your budget is in equilibrium and your debt is going down at this point in time. But I think there's something else and it's a quite simple thing. And if we would be able to resolve that one, that would already make a big difference. We have the strange rule in Europe by Eurostat that if you do a public investment, that you have to take it into your budget of the year that you do the investment, or the 2 years that you do the investment. We have a huge infrastructure work going on in and around Antwerp and the harbor, 15 billion euros. Yeah. We have to take it in the budget of 2 years. Now 15 billion, that's calculated quickly, that's 3-4% of our GDP. There's no company, I think there are a lot of business people in the room, if you do an investment, you let your depreciation schedule come into your P&L account. And that would, for me, being quite orthodox in terms of budget policies, or being in favor of orthodox policies, that would be an important change that would facilitate a lot of public investment of which we are in huge need. Not only with respect to climate, also with respect to mobility. And I think that kind of measure would make a lot more sense than starting a discussion which will, as the colleagues, ministers will enjoy, only lead to nightly discussions that are going on for weeks and weeks and weeks. Just change that one rule, that you take the investment and you do the depreciation schedule on public investment, so that you spread out the impact on annual budgets, and that would already make a huge difference in terms of the investment capacity of the European and certainly the Euro area countries.
It's a great idea, and I look forward to the all-night meetings about how to audit that.
Me not.
One of the things that I hear running through all this is that for every market, you need a buyer and you need a seller. You need a market maker, and yet market makers are also speculators. So there's a lot of frustration with the roles that people are put in, depending on what way people are looking at the problem. I mean, you're outside the government sector a little bit. How do you see this?
So if I may, one comment
Please.
And one question. One comment to the bubble and to the term loan B and other securitized loan kind of secondary market. Of course, I see it only from the industry side, but contrary to what we have seen earlier on before the previous crisis, we don't see today banks putting money into future hopes. We see banks being oriented very much on the cash flows, at least in Europe. Of course, real estate can always cause some troubles, but otherwise, I wouldn't see substantially in the industry the risk, of course, subject to the level of the interest rates. So that's one comment. For the bubble, and this is a little bit related to this problem, there's one bubble which could be out there, but it's a long-term one. And these are all the guaranteed pension schemes and life insurance commitments of different big insurance and companies and pension funds. We see them now how they struggle to get on the returns, especially in the level of the negative state bonds. So we see, especially in the domain of infrastructure, how much they are kind of invading the level of infrastructure, which is not bad. But ultimately, I think we should ask a question whether when they should deliver on their past promises in the 10 to 15, 20 years' time, whether there is not a major gap in between the true value of their future obligations and the real capability of their portfolios to bring interest.
I think you put the finger exactly on where it should be in terms of this discussion, because you rightly speak about those engagement. That's what I meant when I was talking about the liabilities of insurance companies and pension funds. And with the present interest rates, they cannot generate the funds they need in order to keep up with these promises, which indeed they are. And so, per definition, they have to go into risk areas. And the lower these base interest rates are pushed, the more they need to go into that direction. And
Anybody remember
But-
the early 2000s when the U.S. was running a huge budget surplus? And the big fear, Alan Greenspan was worried that there would not be enough treasury bonds. There would not be enough U.S. debt in circulation to keep the market going. I think of that every time I hear about, there's no investment and there's no return and it's too risky. I mean, one way on paper to do this would be to run the German budget deficit way up, get Bunds up to 50 basis points, 60 basis points, get people back into the black.
you know what Greenspan used to say?
I'm being facetious, but you see my point.
If you think you understood me, it must have been that you heard wrong.
Nonetheless, the man had a plan, and he was serious about that stuff. Do you guys have any quick responses? We'll have about 10 minutes for questions, but do you guys have any quick responses?
Good argument.
For me, of course, the most interesting is, of course, the situation of Germany, because, this is the country which may the most substantially impact the others. Also, by the connection to much lesser extent, countries like France or Italy. I mean, Italy has a problem, but but we haven't been really affected by that. So the German case, I would say, is the most spectacular. And so far, they've been claiming not to use any fiscal easing. What I can hear now, they call it shadow fiscal easing. So how to do it, that it is not shown, in the books. And they've been always clever in accounting. So I guess this can be materialized. So, but for us, for the region, we in the region, I mean, we V4, as we often saying, Poland, Czech Republic, Slovakia, and Hungary, we are the biggest partner of Germany. So for us, what's happening, in the German economy, and also in this case, in the trade war, this can have a direct impact, on us. So if we are talking about potential causes, of this recession, of the slowdown, we really have to think about Germany. And also that is very interesting. Of course, we are much more concerned what's happening in our region than in the rest. But at the moment, 80% of our trade is usually, in the European Union. And out of this 80%, that is usually much more than 1/3, which is with Germany. So I would say this is why we are so much interested what's happening in Germany.
Okay. You have a quick thought, and then I'd like to take about 3 questions from the audience. We've got one in the front row, one here, and maybe one other, but please offer us your quick thoughts
maybe
first.
one, just again, coming back on infrastructure investments. And I think there's a great potential in Central Europe, what we call Central Europe in terms of growth and weathering through recession. I mean, if we look back to history, for centuries, Central Europe was like an economic zone in itself, where businesses were trading among each other, people were traveling, and this was the case until end of the Second World War, when our region became part of, I wouldn't call it a value chain, rather a food chain of the Soviet Union. Now, after the fall of the socialism, we became part of the value chain of the West. So basically, the direction of businesses was east to west, and if we are able to reestablish, and this requires infrastructure investments, and this is what there are various initiatives when we are talking about connecting north and south, and if that leads to a reestablishment of a new economic zone, that if I want to buy a car that is manufactured in Slovakia, that car shouldn't go first to Germany and come to us, but goods can move directly here. That's a great potential to move forward for this region.
That's a fascinating line of thought. Okay, we'll take 2 quick questions here in the front row and here. And Daniel, you're up next, so be thinking of your answers.
Good afternoon, Ondřej Houska from Hospodářské noviny, Czech newspaper. I have a question to Mr. Křetínský. you've spoken about what your main concerns are. Now, the proponents of the, let's call them, quite far-reaching green policies that you've criticized claim that they are simply acting on scientific advice, namely that we have to achieve carbon neutrality by 2050. If you disagree with those policies, what alternatives do you have that would still be in line with the scientific advice? Thank you.
And the other question here?
Good afternoon. Thank you very much. My name is Andrei Rădulescu. I'm coming from Romania, from the Bank of Transylvania. I'm the Director of Macroeconomic Research. It's the largest bank in Romania. Very interesting the topics. I used to read Greenspan for many decades in a row. Recently, he said that it's a question of time until the negative yields are reaching United States. We are at the end of the longest cycle in the US economy, which is the largest economy of the world. My question is, who is going to save the world? Because this year, the GDP of China, in nominal terms, is going to outpace the nominal GDP of Eurozone. Eurozone used to be the balance of an unbalanced global economy. So my question is, it's really clear that the global economy needs a new financial system. It's pretty clear that we are living the end of the paper money era. Who is going to save the world during the next downturn, which is knocking on the door? Actually,
right.
You talked about German industry. The German industrial production contracted for 10 months in a row already, so it's a clear recession sign, and probably in Germany we already are in recession. We'll see the data in November, mid-November. Thank you very much indeed.
We certainly heard from Ambassador Korczak a call for Europe to step into the void. So that's something we can keep in mind, but please take it away.
My question, and unfortunately I truly don't know, so I'm truly asking, because it is an extremely complex question. But of course we understand that the low interest rates are actually for the optimal use of the economic potential probably a bit unhealthy, but isn't it reasonable ultimately for Europe to accept it as a fact, interlink it with the financial policies and with the public investment, and simply accept in a way the Japanese scenario of very low growth but very low unemployment, and kind of use the doping of the low interest rates at the longer run, because then the objective problem which we have is of course the impact on the savings of the inhabitants. But this is something where I think Europe could play a role, and institutional measures could be taken, special institutions can be created, capital markets can be created. But essentially, truth is that what gives me the most kind of believe that the recession is not going to come are the low interest rates. So isn't it risky to move the steering wheel right now? And
so before they answer that, I would love for you to keep the floor and answer the climate change question, please.
The risk is that I'm too long. I will try to be very very brief. First of all, I think Europe has to have the ambitions in the climate change fight, and there is no reason why Europe shouldn't be a leader. For me, I have following comments. First of all, we should not create expectations that are frustrating the industrial investments and that are chasing out industry out of Europe. So when we are making, especially at the EU or Western European countries level statements, I think we should make clear that competitiveness is going to be our concern always. So when we talk about carbon neutrality, I seriously believe that it's absolutely necessary today and now talk about carbon neutrality in a way which preserves competitiveness of European industry. If this part of the narrative is missing, I think we are creating huge uncertainties, and we really risk to have substantial economic problems, because we cannot send signals that are not understandable for or scaring the industry. So that's one. Second, if we really want to have real results in the climate change and not only please the activists, we need to act global. Europe, in terms of human activities, causing less than 9% or around 9% of the emissions caused by humans. There's a huge part of other emissions indirectly caused by the humans, deforestation, the way agriculture activities is being done. And we in Europe and in a European debate and in spending our budgets are concerned or are limiting our focus our attention on less than 1% of the global emissions. I seriously do not understand why. I do not understand why we are not taking our money and investing in the climate change efforts in the places where it is the most efficient. I don't see any benefit in closing down gas power station in Europe with efficiency of 46%, while you see coal stations in Russia being built in 1920s still running. I don't see I don't see anything rational around this. So the need to act globally and the need to choose the right narrative and work with technologies that do exist and do maximum so that we develop the technology. Hydrogen could be fantastic technology for the future and can even replace natural gas. But the problem is that today we don't have, in real terms, the technology, and we have no clue about the costs. So how we can talk about a zero carbon economy in 2050 if we don't know whether hydrogen is there, whether it will cost 300 euros per megawatt hour, or 200, or 50, or 20. So that's my problem. We must not create uncertainty for the industry, because if we create this, then we have a real recession, no matter what we do with the interest rate, because we need to keep the reasonable economic activity in Europe. And this is something which, for me, comes at risk. Sorry for being so long.
No, it's great, and given the topic of the panel, it's a great thing to talk about. Okay, so we'll do a speed round on loose monetary policy as a long-term strategy. And my one request as moderator is if you could tease out negative rates from QE, because what the US has chosen to do is more QE, but leaving rates at zero. I mean, broadly speaking, the US hasn't used negative interest rates as one of its tools. It's just had all these different, over the years, quantitative easing measures. So,
but the United States simultaneously raised interest rates and reduced the balance sheet of the central bank.
Eventually.
So they did it simultaneously. But I think the remark of Japan was very interesting, because obviously we there have a very strange situation with government debt in percentage of GDP now at already 270%, 270. With the balance sheet of the Bank of Japan more than 100% of GDP. It has never been higher than 40% of GDP in Europe or in the United States. And so, but of course, I'm asking myself the question, how is it possible that that can continue? Now, one of the obvious reasons why that should very partially explain it is that, of course, Japan is a very homogeneous society. And if there are costs to bear, there's much more a tendency to bear them by society as a whole. I invite you to come to discussions within the Eurogroup or ECOFIN whenever there are economic costs to be divided.
Understand. Understand.
End of my argument.
Very well put. Final closing thoughts. Try and keep it to a minute or two, please.
If we go up,
you know, the main subject is recession. I still believe that overall this will be a slowdown. I think we are better prepared than we were, 10 years ago. That is quite a long, life cycle of which we've got now, the longest in the United States. Of course, quite a long, in Europe. So it will be slowed down, and we should make assumption based on that. However, I think, there are different policies in the Eurozone, and we could hear it very, very easily during the Eurogroup debate. So there's a very clear difference between Eurozone members and the rest. And the rest is not only us, the rest is also Sweden, Denmark, UK leaving. So we are not left alone, some of us. So there will be, different responses. And I think that the countries without euro, they are better prepared for combating recession if that happens.
Mr. Giel?
I can repeat partly what Mr. Minister said. I think we are better prepared for the next recession. Whether we are better prepared for the next big thing that is coming out of nowhere, that I'm not sure. At least looking in my country, our finances are in a much better order than they were back in the previous crisis. So from that point of view, I think we are we are better prepared for whatever is coming next.
Thank you for that assessment. Thank you to all of you. I believe we have a coffee break next, Ray. And thank you to the organizers for a very fine
Thank you very much.
couple of days of summit.